What's up, guys? It's Dylan here. So, I know it's been a stressful week for all of us, and honestly, this week I didn't even really want to do a video. I was just so stressed, my job and all the news that's been going on in my head. Just my head's hurt all week, and it's just been crazy. But, I really enjoy doing this. I really enjoy making these videos for you guys, and life goes on. So with that being said, let's get into the video. I was talking to a friend this week. I told her about these things that was going on, and I said, I don't even really have an idea for a video. I hadn't really thought about it. I've just been so stressed that I really hadn't had time to sit down and plan a video like I usually do. And so she sent me this article from CNBC entitled, "Before Coronavirus Crash, Many Big Corporations Broke the #1 Rule of Personal Finance." So, just 2 weeks ago, I had made a video about why you needed to save for an emergency fund. Well, it looks like these big companies never learned their lesson on saving for an emergency fund. Giant employers of low-wage workers like McDonald's and Starbucks spent and borrowed money for stock buybacks and dividends. Now companies are trying to tap credit to manage to manage cash and avoid layoffs. Labor unions and experts say that shareholder money could have gone to worker raises and to shore up the balance sheet during the bull market to better prepare for a financial downturn. The tax cuts of 2007 are also now being scrutinized. Kitchen table finance begins with one simple rule: have several months' worth of expenses on hand in cash in case something unexpectedly goes wrong, just like we talked in that video. Some of America's biggest employers are beginning to discover the truth of this maxim as the coronavirus crisis catches them short of cash just as business crashes. Together, the restaurant, leisure, and hospitality and airline industries account for 17 million U.S. jobs. And there's another reason why workers are likely to get laid off if the crisis persists. Their employers are short of cash, often because of stock buybacks. And on a side note, I was just talking to this friend, actually, and her job, it is stopped right now. No business, no nothing. And she told me that the company that she works for only has 8 weeks of money. And after that, they would run out of money and probably have to file for bankruptcy. 8 weeks, people. That's crazy. Says here, this complicates the case for developing plans from the Trump administration to offer some form of federal bailouts to industries like casinos, airlines, and maybe even restaurants hit hard by the sudden loss of business as states and municipalities order non-essential businesses to close or curtail their operations. I know a lot of businesses here in my state are restaurants are takeout only now. No drive-through or takeout only. You can't go in and sit down at these restaurants. So, what about waitresses? that's going to affect their tips. It says here, this is more of the acceleration of shareholders over sensible business planning, said Judy Conti, Government Affairs Director of the left-leaning National Employment Law Project. It's yet another indicator of the failure of the 2017 tax bill. It didn't encourage higher wages or new jobs, but more greedy practices. It's not greedy practices. These businesses need to have an emergency fund, just like me and you. These people don't get it. It says no blank checks bailouts. In fact, lawmakers and airline unions came out on Tuesday to say there should be no blank check given to airlines who spent on stock buybacks. I agree. Instead of having a rainy day fund on hand, like they should have, employers in the affected industries are trying to get by with as little as 1 to 2 months revenue on hand in the form of cash or short-term securities. In this, many employers in hospitality and restaurants are the opposite of tech giants like Microsoft and Apple, whose giant cash positions are available to help the companies ride out the storm and retain more of their workers. Also, Berkshire Hathaway, didn't mention this, they have a huge cash pile reserved. And that's exactly what these companies need to be doing. You have two issues. How much cash do they have, and how big of a credit line? Said Charles Elson, a corporate governance expert at the University of Delaware in Newark. There's no standard number for cash on hand. Credit lines aren't typically used for salaries, but in an exigent situation, you gotta do what you gotta do. Take McDonald's. With $21.1 billion in revenue last year, it ended 2019 with only $898.5 million in cash on its balance sheet. A little more than 2 weeks worth of sales. Considering that the fast food chain, which owns more than 2,600 stores, franchises 36,000 more, and employs 205,000 people, generated $5.7 billion in free cash flow last year. It could have as much cash as it wants. Instead, McDonald's bought back $4.9 billion worth of stock in 2019 and paid another $3.6 billion for its dividend, almost exactly the $3.24 billion the company borrowed last year. As McDonald's goes, so goes the fast food industry. This person said they were in a position to raise wages and set an example for other companies to follow. Instead of that, they went into debt further to enrich shareholders and executives. Doesn't surprise me. Executives always win, just like in 2008 when we bailed out the banks. McDonald's announced on Tuesday it was unable to provide financial guidance because of the uncertainty related to the coronavirus and would work with franchisees on rent deferrals. In its fourth quarter earnings call, which a spokesperson referred CNBC questions to on Monday, Chief Financial Officer Kevin Ozan had retreated the company's goal of returning all of its free cash flow to shareholders through dividends and buybacks, while adding $1 billion a year to the company's $34.1 billion in debt. McDonald's also has $3.5 billion credit facility that could help it ride out the sudden burst, according to the company's securities filings. McDonald's disclosed over 200,000 employees at the time of its last annual report, 2018, including company-owned and operated restaurants, but 90% of its locations are franchised. The story isn't much different for Starbucks, which employed 346,000 people as of December 31st, but it reduced to a takeout business in U.S. locations, obviously because of coronavirus. With $26.5 billion in sales last year, it only has $2.76 billion in cash, or about 6 weeks' expenses. So Starbucks couldn't even make it 2 months if something like this in this situation. It made $3.24 billion in free cash flow while spending $10.2 billion on buybacks and another $1.76 billion on dividends, giving shares a 2.6% yield at a stock price that's down around 35% this year. Starbucks employed approximately 346,000 people as of September 29, 2019. In the U.S., it has over 200,000 employees in a company-operated store. In company-operated stores. Starbucks is providing up to 14 days of catastrophe pay for all workers who have been exposed to the virus. McDonald's has extended paid leave benefits for some workers at corporate-owned restaurants. Yum Foods, which owns KFC, also returned more money to shareholders than it generated. Way to stay in business. But it increased its cash position by $300 million during the year to $743 million by shrinking its buybacks by about 2/3. Darden Restaurants also built up cash in 2019 while buying only $207 million of shares. Let's talk about casinos. Some big casino companies are also in cash shortages of their own making. Las Vegas Sands, controlled by Sheldon Adelson, whom ProPublica called Trump's biggest patron in 2018, paid out more than its 2019 cash flow as dividends alone, and reduced a cash position it had busted in 2018 by more than $600 million, but it still has more than $4 billion on hand. Wynn Resorts paid $566.5 million in dividends despite negative free cash flow. It has cash equal to at least 5 months' expenses. Wynn on Tuesday asked Congress for emergency aid. See, this is right here is one of the things that makes me mad. Is that these companies want to blow all this money. They don't want to save. And they want you and I to be on the hook for it. That's not right. Some companies short on cash thanks to the business interruption of the coronavirus got that way because they spent 2019 reinvesting profits in their businesses. That's the story at both of the world's 2 largest cruise lines, Carnival Corporation and Royal Caribbean. Both made plenty of profit and generated billions in operating cash flow. $3.72 billion at Royal Caribbean and $5.48 billion at Carnival. But they spent that money mostly on new upgraded ships. Capital spending was $5.43 billion at Carnival and $3.02 at Royal Caribbean. But both found the money to buy back at least some shares. Carnival spent $600 million on buybacks and $1.39 billion on its dividend, which it financed indirectly by issuing $1.4 billion in new debt. New debt. You can't even pay your old debts off, but then you're issuing $1.4 billion in new debt. Royal Caribbean spent more than $700 million, most of it on dividends. So they don't even have the money to fix their ships or update, build new ships or update the older ones. But they spent more than $700 million by just giving it to shareholders. Carnival said money that it that it is tapping the vast majority of its $3 billion credit line to bolster its cash positions. Well, had you just been saving money in the first place, you wouldn't have had to borrow $3 billion from your credit line in the first place. Companies are rushing back into the debt market at the first available opportunity after all but shut down last week. I don't know about you guys, but I see another 2008 coming. On Tuesday, Verizon, ExxonMobil, Pepsi, and Bank of America were all expected to issue bonds. Airlines are a mixed bag. They're vulnerable to bankruptcy as soon as May in some cases, thanks to high, mostly fixed costs for planes and workers. So the drop in business this month threatens to wipe out the profitability they enjoyed in 2019. United Airlines Holdings has been trying to build up its cash position, paying no dividends last year and ending the year with $4.94 billion in cash. Still, only about a month's worth of expenses. But up $1 billion from last year, it spent more than half of its 2019 operating cash flow on capital spending, mostly new or upgraded planes, and bought back $1.65 billion of its own stock. So they don't even have the money. They only have a month's worth of expenses, but yet they're buying $1.65 billion of their own stock back. That don't seem right to me. Call me crazy. It said this week all corporate offices were taking a 50% salary cut as its March revenue decreased by $1.5 billion. It said talks with unions about payroll reduction began over the weekend. Delta had less than 1 month's expenses in cash as of December 31st and spent about 60% of its $3.49 billion in free cash flow on buybacks and $980 million in dividends. But it also invested most of its $8.43 billion in operating cash flow back into its business. Now, that's some good news. Southwest has about 3 months' revenue in cash and only spent 2/3 of its 2019 free cash flow on buybacks after investing $1.03 billion in its business. It's just the last few days the impact of the coronavirus has really hit home and disrupted the daily routines of hundreds of millions of people in the United States and around the world. United CEO Oscar Munoz and President Scott Kirby wrote in a letter Sunday announcing a 50% cut in flights through May and the 50% cut in compensation for company officers. We took early aggressive action because we have been determined to do everything possible to avoid painful steps that affect your paycheck. But based on the severity of the situation, that no longer appears realistic. CFRA airline analyst Colin Scarala said some airlines, sorry if I'm pronouncing that wrong, like Delta and Southwest, have notably conservative balance sheets that make stock buybacks more appropriate. They've got plenty of liquidity. For a few months, they're being optimistic and seeking government help. This person said, they're not going to be doing any share repurchases this year. They're going to spend less on CapEx. They're going to talk to Airbus and Boeing about stretching out deliveries. This is why I made the emergency fund video, because this is something that I feel so strongly about. Nobody saw this virus coming. Nobody saw this huge decline in the market coming. Nobody can predict it. It could happen just like that. That is why that's why I made the emergency fund video, and that's why I'm making the rest of these videos, because I want people to be prepared for anything, because you never know what's going to come in the future. So, with that being said, I hope you guys enjoy this video, and hopefully we can all get back to normal soon, and all this stress and talk of the coronavirus, hopefully it'll be over soon. So, with that being said, we'll see you on the next one, guys.